Hi, everyone. I'm Elma with Java. Today for our speaker series we have Tracy Meade, who is a long-term care consultant, and she's going to be talking to us a little bit about long-term care insurance and how to navigate that system. I'm very excited to hear about this, and without further ado, Tracy Meade.
Thank you, I appreciate it. A certified long-term care consultant is a fairly recent designation in the financial services industry, so a lot of people don't know what that is. But financial advisors and certified financial planners aren't trained in long-term care planning, so this is the education that you need to be able to assist people so that they understand Medicare, Medicaid, veterans benefits, all the things, the moving pieces that could be involved in long-term care planning. So that's a little introduction about the work that I do. Most people know what long-term care insurance is. When they're in a care situation, a lot of people don't own it and wish that they did, or their family doesn't own it. But it's the insurance that pays when most likely you're out of the hospital and either in your home or in some type of community. Medicare has a limited payment for long-term care. Normally, policies are triggered by your inability to perform 2 out of 6 activities of daily living: bathing, dressing, toileting, maintaining continence, transferring, getting on or off a bed or a chair, and eating. You can't feed yourself. So 2 out of 6 of these are usually what is a trigger for you being eligible for your benefit, or a cognitive impairment. A lot of people now are being diagnosed with dementia and Alzheimer's, so we have a lot of people with cognitive impairments, and their families are managing their care, and because they can bathe and dress themselves, they think that their policy, they can't file a claim on their policies, which is not so. If they're not able to go to the grocery store and find their way home by themselves, get lost, that kind of thing, then they are in a position where they can trigger their benefits. The fact that they don't need assistance with showering and dressing and all that is irrelevant. It's one or the other. It's the 2 out of 6 ADLs or it's the cognitive impairment. And so I'm seeing a lot more folks with the cognitive impairment and wives trying to manage husbands and husbands trying to manage wives. So it's really stressful, and a lot of times they leave money on the table that they aren't aware of is available if they would file their claims sooner. So with long-term care insurance, we've had people living so much longer. When Social Security was set up in the 1930s, it was set to pay out at age 62, and the average life expectancy was 60. And so that was living too long if you lived to 62. I go to the center at Belvedere on a regular basis. I see people 60, 70, 80, 90, close to 100 still coming out, participating. And so we have a much longer lifespan than we used to have, and that's because of the advent of statins. Statins, heart disease is the #1 killer in our country, and because we have bypasses and more drugs and more procedures, people aren't dying as soon as they used to. And so if you live a long life, then you have the situation where you may become more frail and need assistance. And so a lot of people don't realize, in addition to the ADLs, there are IADLs, which means when these policies are triggered, you can pay for someone to do your driving, your shopping, managing your finances, all kinds of services that don't fall under medical care. And so people don't realize that people can run and do your laundry, or you can send them to the grocery store. You don't even have to go with them, that kind of thing. And so a lot of times people are reluctant to ask aides to handle these responsibilities when it's something that is covered under their policies and it's a benefit they're entitled to. And so when people think about long-term care insurance, most people think of it as nursing home insurance. It's the place nobody wants to be. And so there's a lot of variation between a nursing home, which is a skilled facility, and an assisted living community. And we're seeing the bundling of a lot of memory care units with assisted living. And so people are very confused about what these communities are, and they think that all communities provide the same services, which is not the case at all. So a lot of times people don't file claims for home benefits because they don't realize they have home benefits. I will meet with a woman and she'll say, oh, well, my husband was at home, we took care of him for so many years, but we never filed a claim. They didn't even look at their policies to see if they had home care benefits because they assumed they only paid in a nursing home. And so early policies were just that. They were nursing home policies. And they were written so broadly, they didn't pay for much. And so this type of insurance got a bad rap because of the fact that they promised the moon and didn't pay a lot on the claims. But eventually the state of Virginia stepped in, and we are a partnership state. So there are certain portions of, there are certain rules that these policies are structured under, with things like inflation increases, the fact that if you don't make a payment and the policy lapses, they get a larger window for you to reinstate the policy. If you've owned the policy for more than 3 years and you can't afford to keep it, you get out in care what you paid in premiums. And so a lot of times people don't realize that. So there's a lot, these policies are a lot more robust and have a lot more benefits than people realize because most people don't read the policies and know what's in them. So I can understand why they don't know that, but I just see people leaving a lot of money on the table because they don't realize what they have. And so most people start out in home care. About 70% of people stay in home care. That's where they choose to age, and that's where they eventually pass. About 20% of the population ends up in some type of assisted living facility, and about 10% then ends up either in skilled nursing or in hospitals. And so this thought that this insurance is just for skilled nursing, when most people don't go there, and most people don't want to go there, that they don't realize that there are robust benefits to take care of them in their home, which is generally the location of their choice. Most people want to age at home. And so knowing the difference between these different communities helps you to put together a plan and assist people when that time comes, whether you got family members or friends who might be struggling with some of these decisions. Knowing the difference between skilled facilities, assisted living, and the types of benefits that are paid in those locations can be very beneficial. Our policies are written so broadly, they will also pay for alternative plans of care. Meaning if there's some technology that's not been discovered or used at this point, the language is so broad that they will cover potential future advances in care, robots for dispensing medication potentially, and things like that. One of the most economical ways for people to purchase coverage is a husband and wife purchasing a pooled benefit, because then you're spreading the cost over 2 people in one policy. And a lot of people think that these policies will have like a benefit of 2, 3, 4 years. Oh, there's a clock ticking, this is going to run out in a certain amount of time. And that's not the way it works. You have either a daily or monthly benefit, and once you trigger that benefit, it's the amount of money you're taking out each day or each month that reduces that pool for care. So let's say that you have a $200 a day benefit, but you only needed $100 a day to get someone to come into the home and assist you on a part-time basis. If you had a 3-year policy, that becomes a 6-year policy because you're not going to run out of money as quickly. And so a lot of families don't start a claim because they're like, well, it's only for 3 years, we need to save it. We don't want it to run out. So we're not using it for home care because we're waiting if they have to go to a nursing home, things like that. When they could have people coming into their home and taking care of their family members, and that's where people want to be taken care of. So understanding how these things are used is beneficial for them getting the most out of the policies. Like I said, we're a partnership state, and so there has to be inflation protection in the policies. Normal inflation is rising about 2 to 3% per year. Healthcare is rising about 6 to 7% per year. Most of these policies don't have 6 to 7% options, but at least you've got 3 to 5%, for you to be able to at least curb some of that inflation, because the policies will actually buy less over time if you don't have that inflation protection. Your dollar is going to not going to go as far. Elimination periods are usually waiting periods, and a lot of policies have 90-day waiting periods. And the reason they use the 90-day waiting period, Medicare pays for the first 20 days if you have a 3-night stay in the hospital and then have to transition to a skilled facility for rehabilitation, that type of thing. So Medicare will pay for 20 days, and after that, they'll pay up 100%. After that, from 81 to 100, you've got the 80-20. They'll pay 80%, you pay the 20%. And so usually if a person comes out of a hospital environment and they've been really ill and they move to some type of skilled community, they may not have to meet that deductible. When people age at home, that's different because Medicare will not be contributing potentially to this situation because most of their services that they pay for are rehabilitative in nature, and a lot of them are performed in communities and not at homes. And so people need to understand CMS is the Center for Medicare and Medicaid. There's no payment in assisted living for their services. There's only payment in a skilled nursing facility. So it's important that you understand the difference between those. And then the ways that the insurance companies count the elimination period, some will give you credit for 7 days if you only have care for 1 day that week. So they have different ways to count that elimination period. So it's really important to read your policy and understand the benefits. And I recently was helping a gentleman up in Maryland, and his father he has a very short lifespan. He has a lot of conditions going on, and he has recently left the hospital and moved into assisted living. And basically the community wanted to put him on hospice, and he didn't want to go on hospice because he figured he was giving up if he agreed to go on hospice. But his insurance policy would waive that 90-day waiting period if he was being treated on hospice. And his care wasn't really going to change very much because of where he was at and all of the issues that he had. But it was that mindset of, I don't want to go on hospice that says I'm giving up. And I said, but your care isn't going to change day to day. You're going to be getting very similar care, and it's saving your family $30,000 not to have to pay those first 3 months out of pocket. And so it's awful, but sometimes you have to break it down in dollars and cents to say, is it worth $30,000 to not wear the badge that you're on hospice when there is a program that will pay for this? Medicare normally pays for the hospice services, but they don't pay for hospice house. So if you need to be in a community that provides room and board, that would fall to you or your family, or would be paid through your long-term care insurance policy. But Medicare takes care of the actual hospice services. And so again, lots of different conditions in these policies, and it's not a simple process to stay on top of it. And so the elimination days, as I was saying, they may use different counting mechanisms as to how they get to their 90 days. But basically, most people have some type of a elimination period on the front end. Some of the insurance companies have gone to shortening that up. If you start out in home care, they may not charge as many days for elimination, or some of them have 0 elimination. Start on day 1. If you meet your 90 days at home and then you have to transition to a community, then you won't have to pay another waiting period when you get to that community because you've met that waiting period at home. That's taken care of. So most policies, you only have to meet that elimination 1 time, and after that's met, you don't have to worry about it. And so, again, lots of moving pieces. As I mentioned, if you start out in home care, a lot of policies will waive that 90 days or shorten it. Some policies will shorten it to 30 days. You don't have as long to meet that deductible. As I mentioned before, hospice is a service that's provided and paid for by Medicare, but the room and board that might be tied to that could potentially have a charge, and that's where you would need to have payment, or like his policy, a clause in the policy that says, if you're critically ill, we're waiving the elimination period. And that was the only policy where I'd ever seen that language before. And I read through that and I thought, well, this is great, because if he agrees to be on hospice, then the family doesn't have to worry about it. And he's likely getting the very same care he would be getting not on hospice, just because his health has deteriorated to that point. He has a lot of issues. And so a lot of people don't realize that these policies, in addition to paying for care, can pay for home modifications, medical equipment, respite care, training for the family or friends if some people are helping you out, informal caregivers wanting to help you out so you don't go on a full claim and use up your benefits. A lot of that training can be built into your policies and you don't have to pay for it. They also cover geriatric care management, which is someone who manages your health care when you're trying to initiate a claim. And initially, you were allocated a dollar amount per year, but I'm seeing more and more policies where they want you to call them, like Genworth, and they have negotiated rates with home health care agencies. And so because they're negotiating for a larger group of people, they say they can get better pricing. And so they want you to use their people. That saves them money if they're able to help you to get lower pricing. You always have the right to your own geriatric care manager. It's just a matter of whether or not your insurance will pay for it. You know, if it's embedded in the policy, you have to use their people. If you want to pay for your own, that's fine, you can do that. But that's been a switch. But there are a lot of benefits in these policies that just people don't realize, and they really help in those early months when you're just getting started. Like I say, for home modifications are big if you need ramps and guard handrails and things like that. And while Medicare might pay for a ramp, it won't pay for a chairlift. And so some people want a chairlift to get up and down in their home, and that's the type of thing that their insurance policy could likely pay for because they own a long-term care insurance policy. So again, knowing what things that are covered, there's a lot more. They'll cover first alerts, they'll cover a cost for oxygen. There's all kinds of things outside of the care benefit that are embedded in these policies. Most insurance is structured on a reimbursement basis, and so you have to spend the money to get the money. And so that's what most people are familiar with it. But indemnity and cash indemnity policies are policies that will pay you cash based on whatever the mechanism is, whether it's a daily benefit or a monthly benefit. And some don't require that you spend the money for care. So some of them can be tied to the number of days that you had care. Others can be, okay, you triggered the benefit, you're going to get X amount of money per month. You don't have to spend it on health care. We're just giving you X amount of money per month. How you use it is up to you. And right now, the current exclusion is over $400 a day. So you can get up to $400 a day and not have to pay tax on that money, because if it's coming out of a qualified long-term care insurance policy. So more people are looking into indemnity policies and wanting that because they can pay family or friends for their care, and it's not as expensive as hiring agencies. So they're becoming more popular. So there are a lot of moving pieces in the long-term care world right now. There are also hybrid policies that are built around life insurance or annuity contracts, whereas traditional long-term care insurance is a use it or lose it. If you don't use the benefit, your family doesn't get a death benefit, doesn't build cash value. It does protect assets from a Medicaid spend down. So if you have $300,000 in a policy and you need to spend down to qualify for Medicaid, you can protect $300,000 worth of assets. Whatever amount you owned in insurance can be used to protect assets. A lot of people don't realize and liquidate their assets when they could have protected some of those if they were aware of those rules. And so people are tending to look towards, and another downside to the traditional long-term care insurance is the price is not guaranteed, and so those prices have been going up. Excuse me. And so when you buy a policy, you may know the cost when you purchase it, but you don't know long-term what the policy is going to cost you. So that's one of the downsides to traditional long-term care insurance, and it's a reason people don't look into it or purchase it. But when you look at the cost of care versus the cost of insurance, if you can afford it, you're getting a bigger bang for your buck because you've leveraged that money to get a greater pool of care, and you're getting it tax-free. Which, if you're taking money out of your accounts, retirement accounts, you've got to take that haircut for the federal and state taxes that you might not have paid yet. So you're liquidating a lot more money to get the same pool of funds to pay for care. Again, that's things that people aren't aware of because of the fact that they get such a robust benefit and it's tax-free. Normally when you're making a claim, it's not the patient who's making the claim, it's a family member, spouse, that kind of thing. And so because of HIPAA, no one else can talk to the insurance company about your policy unless they have power of attorney or they've granted permission for a third party to access your information. So in most instances, I'm rounding up powers of attorney and getting that information to the insurance company so we can open a claim. And a lot of them are putting the claim filing information online, so you can go to their websites, find the forms that you need. But there's a lot of paperwork on the front end of a long-term care insurance claim. Communities don't normally file claims for people who are residents, and so normally they need an independent person like myself to help locate the paperwork, the power of attorney, all of those things, and get it started. And then you also have to name who is going to be your provider, and they check to make sure they're licensed and meet the criteria of who they're going to pay for care. Some policies will pay for informal care, some have limits on informal care, some will not pay for informal care, some will pay family members, some won't. So again, you have to read the fine print to know how the policy will pay the benefit. But there's a certain amount of paperwork on the front end, and it usually takes about 60 days or so to get the claim started. In the meantime, if you didn't come out of a hospital situation, the community wants their money the first of the month. You have to pay and then wait to get reimbursed. They are not going to file your claims for you. They would file for Medicare or Medicare supplements, but they don't file for long-term care insurance. That falls normally to you. Insurance companies will allow communities to accept an assignment. So once you get the claim open and if you've got a benefit coming, you can potentially set that up so the insurance company pays the community and you just pay the difference if there's a difference instead of having to put out the money and then wait to get reimbursed. But that's once a claim has been established. And I see more communities helping people file their claims, and that's a good thing. Keeps the money flowing. And like I said, there's going to be a certain amount of documentation that needs to take place before a claim is open. Generally, you have someone who comes out who works in the healthcare field to develop what's called a plan of care. And they indicate the services you need, the deficiencies you have. This is where you're looking for that 2 out of 6 ADLs or the cognitive impairment. And so they've got to say why this person qualifies and needs this service. It used to be, if you have a cognitive impairment, that was the language. Now the language is a severe cognitive impairment because people get diagnoses, but they may not have a lot of symptoms for 4, 5, 6, 7, 8 years. And so it is the degree of how much that dementia has progressed that determines whether or not they're eligible for benefits. So sometimes people file too soon because they're not quite there yet. So I help to counsel people on what types of things would trigger the benefit. And again, couples, one will be there with them and they're coaching them or telling them things. It's like, no, it's what can this person do by themselves? Could they live in a home? Could they go to the grocery store, buy groceries? Could they find their way home from the grocery store? Well, about 80% of the time, I said, that doesn't work. He's got to be able to find his way home 100% of the time, or he qualifies for the benefit. So there again, people don't start the claims as early as they could because they don't realize he can bathe himself, he can dress himself, but he can't be trusted to go out in the community and make his way home in a car. That's a different situation. So he needs that oversight. They want you to turn in your paperwork as soon as you start to incur an expense. They would like it within 30 days of when that expense is. Like I said before, usually takes about 60 days or so to get the process going for a new claim. And once you've gotten things in place, it really isn't that difficult particularly if you can load the information to their websites and pull forms off their website. It's a lot easier than having to mail things back and forth. But for most seniors, that means you need to have someone who has a scanner and a computer that can help you with the claim. I don't have a lot of 80-year-olds scanning and emailing and getting their claims processed. It's usually a family member or myself who's having to do those things to get the money flowing. And so I can help people initiate a claim and continue on and stay on that claim, or I can initiate a claim and teach your family what they need to do to keep the claim up. You will have to be recertified. Most companies require that to be just once a year, but they'll come back and say, have your needs changed? Do you still need these services, or do you need new services? Just so that they stay on top of what they're paying for. And again, these bills, these invoices from outside companies have to list the codes for the types of services that they're receiving of those 2 out of 6 ADLs. Each day there has to be a code for the services that they were receiving. And as we're saying, this redetermination, they reevaluate. Normally that's once a year, but they can do that on a shorter time frame. Some insurance companies do 6 months, but most of them are following on once a year for recertification. There's my contact information, and I'm here to answer any questions, comments.
You said that there's like 3 to 5 plans once you sign up for a plan.
Mm-hmm.
Is that, can you get it extended to a longer period, or?
Once you purchase a policy, you're normally locked in on what you've purchased. What you can do is make changes to your policy and reduce it. But most instances, you can't increase it. There is a company that does send out notices and says, do you want to buy more coverage? But you can do it in 3-year intervals. And you have to do it consistently, or they take that offer off the table. If you don't do it for 3 years, then you don't get the offer again. And so a lot of these traditional policies, I help people because of the fact that the premiums are going up and they're getting more expensive. I help people look at their benefit, their time frame, their inflation, and see where we can make cuts to reduce the premium. So a lot of people don't realize they can do that. So I recently met with a woman who just moved into the Barclay, and she had like a 6-year time frame on her policy, and it was getting more expensive, and she had I can't remember, I think it was about 3% inflation, it might have been higher. And so I said, well, we can take the inflation off. That means the benefit is not growing anymore. But she's 80-some years old, so, she's got over $300 a day. That's pretty good. And I said, it's better to keep a higher daily benefit than a long period, because a long period at 150 is not the same as 300 a day for 3 years, because of the fact that if you need 300 a day, you're not taking that money out of pocket. And most claims don't go on that long. For most claims, men's claims last about 2 years, women's claims last about 3. Of the measured claims, the problem is the vast majority of care delivered in homes isn't measured, and it's free. So it's hard for us to know how long people were in a care situation. But that 2 and 3 year mark are the measured when we know that someone was receiving care. So I talk to people all the time that took care of somebody for 6 or 8 years before they then had to move them to a community because it had gotten to the point where they couldn't care for them anymore. So these, claims can certainly be 10 years or more if you've got dementia and Parkinson's and things like that. You can have very long claims. But the vast majority of them don't last 10 years or lifetime. So if someone's in their 70s and 80s and they've paid for a lifetime benefit, their lifetime is shorter than somebody that's in their 40s or 50s. So we can shorten that down and say, would you be comfortable with 5 or 6 years of benefit and not lifetime? If so, then we can cut the premium. So I help people cut their premiums in half, and they don't cancel the policies when they would have if they didn't know the difference, just let the policy go. The traditional long-term care insurance in the state of Virginia has to give you in benefits what you paid in premium if you can no longer afford your policy. So a lot of people don't realize that if you stop paying It's not that there is no benefit, like your car insurance or your homeowner's insurance. If you have that policy for more than 3 years, then you have to get out in care what you paid in premiums. And we also had the problem of people maybe in a hospital or whatever not paying their premiums and having policies lapse. And so you're allowed to add people to the policy. They can get a notification if you don't pay. But generally speaking, the policy will lapse after 60 days. And so I just had a call today from a guy. Mom found out they hadn't paid the policy, they paid it, and unfortunately it had gone up, so they didn't pay the full premium. And the insurance has been canceled. And they're hassling with trying to get that reinstated. And so I gave them some advice, but I said, all is not lost. If they don't reinstate her, she's in her 90s. And he says she's probably paid $100,000 into this policy over her lifetime. And I said, well, she will then have about $100,000 in benefits. So there is still something there for her to use. So it's not all lost. But that is a big issue with seniors forgetting to pay the bills or it getting too expensive and they think they don't have options, so they stop paying for it when they could have made changes to the policy. What most people are looking at these days are hybrid policies, which are they're designed around life insurance or annuity contracts. They have guaranteed premium, they build cash value, they take out benefits if you don't use them. So they're very desirable for people who want to plan because then they know this is what my cost will be. It's really hard right now for people to plan on the traditional long-term care insurance because some companies are having major increases while others aren't. Case in point, Mass Mutual had an increase a couple of years ago. They increased the premiums 90%. They basically doubled in 1 year. They have to go to the state and get permission to do that, and the state looks at the claims that they have to pay out and says they need this money in order to pay these claims. So they don't willy-nilly get to raise the prices, but these approvals have to come from the Bureau of Insurance saying this is necessary to pay the claims. So there is some oversight, so these companies don't run out of money so they can pay the claims when they're filed. And that's what a lot of people worry about, is when the time comes that they might need the benefit that the insurance company may not pay. But I'm not having that situation at all. If you legitimately qualify for the benefit and we have pushed the right amount of paperwork, they will pay your claims, they will send your checks, and if you have the cash benefit, they will give you cash and deposit in your account each month. So that's a great thing.